Hello everyone, welcome back, and now we are going to discuss question number 36. So this is going to be an interesting part where we are going to learn lots of things. Question number 36 in front of you. Let's have a discussion. Seawell Corporation is a company. It is a manufacturer of hardware and housewares. Reported earning per share of 2.10 euro in 2013, on which it paid a dividend per share of 0.69. So have a look. First of all, its EPS is given to us in the question, which is 2.10. Dividend is already paid, so can I say that this is D0? Right. Earnings are expected to grow 15% a year from 2014 to 18. Okay. During this period, the dividend payout ratio is expected to remain unchanged. See, underline the word dividend payout ratio is expected to remain unchanged and mark like this and write down a couple of things. It means dividend per share will also grow at 15% from 2013 to 18. Sorry, 14 to 18. See, when the earning per share is growing at a particular rate and the dividend payout ratio is also same, that means dividend payout ratio, dividend per share is also growing at 15% at the same rate at which EPS is growing. Okay, and the payout ratio, see, but the story is changing after 2018. After 2018, the earnings growth rate is expected to drop to a stable rate of 6%. So earlier for the 5 years, it was growing at a higher percentage of 15. And then after that, 2018, it is still growing, but at a lower percentage of 6%. And that too stable, that means for perpetual. And the payout ratio is expected to increase to 65%. And at that time, after 2018, the payout ratio will become 65%. The firm has a beta of 1.40 currently, and it is expected to have a beta of 1.10 after 2018. So this is a question which is divided into two different parts. The first part is the first 5 years, and the second part is the perpetual. For both the timelines, there are different datas. The data for the beta is also different in both the period. Dividend is also different in both the period. The market risk premium, underline the word market risk premium. Premium itself means RM minus RF. So you need to be very cautious while reading and interpreting the question. So there keep no space for nervousness in exam, because when you are nervous in exam, what happens is you tend to miss out on this word premium, and what you are going to do, you are going to just misinterpret this 5.5% as a market return, RM. The treasury bond, that means this is going to be RF, risk free rate of return. Bond, treasury bill, government of India bonds, etc. What is the expected price of the stock at 2018, means after 5 years, and today at 2013, using two-stage dividend discount model? So have a look. One thing which you need to clearly understand, this is question number 36. Is this entire question is divided into two parts, 5 years and then perpetual. 1, 4, 15, 16, 17 and 18. So this is 13, 14, 15, 16, 17, 18, right? Earning per share, dividend per share. Let's write down 2.10 euro, 0.69. Okay, now we are going to make sure that the earning is being increased by 15%. Just a second. 15% every year. I will have to show that to you as well. Right. So come to this point. Can you see the calculator? Just a second. Right. Pretty much visible to you. See, when you know that every year it has to grow by 15%, we should be able to do quick calculations of every year's earning per share. We know the common figure in every year is 1.15, that 15% of the growth. So that should be kept in the calculator first. See, 1.15 is kept in the calculator. Just a second. Let me adjust this. Okay. Then multiply 2.10, then press equals to, and you will get the first earning per share, which is 2.41. Then press equals to 2.78, then press equals to 3.19, then press equals to 3.67, then press equals to 4.22. This is the quickest method of calculating the earning per share of every year, when you know 15% is the common growth for all the 5 years. Obviously, the 6th year growth rate in earning per share is 6% multiplied by 1.06. So that will be 4.48. Okay, we are going to do the same with the dividend. So the first thing that I'm going to keep in the calculator is 1.15. Can you see that? 1.15. Then press into, then press 0.69. Okay, you have kept all these figures in the memories. Then press equals to 0.79, 0.91, 1.05, 1.21, 1.39. After 5th year, please understand, the question clearly says that the dividend is not growing at 15%, the dividend is also not growing at 6%. It is nothing but the 65% of this EPS, 4.48. So simple calculation will do the work, 2.91. Understood how to calculate the values quickly on the calculator. I am sure most of you might have known about this technique earlier also, but still it's my job to explain to those who didn't know about it earlier. I will just write it down. The method. First press 1.15 on the calculator, then press multiplied by, then press 0.69, then keep on pressing equals to button. You will get the values. Okay, this is the method. So what happens in that case is 1.15 and multiplication is kept into the memory of the calculator, and every time you press equals to, the resulting figure gets multiplied by 1.15. The resulting figure gets multiplied by 1.15 because you have kept that first in the calculator. So that was kept by in the memory by the calculator. Okay, let's move ahead. So these are the two different phases. Now understand the beta is given here, 1.4 and 1.1. So 1.4 is the beta here and 1.1 is the beta after 2018. The risk of the two different duration or timeline is different. RF and RM minus RF is also given to you, 6.25 and 5.5. So RF is 6.25, it will be applicable for both the periods, 5.5 applicable for both the periods. So why there are two different data given, beta given for the two different areas? It's very simple, sir. The cost of equity by which you are going to discount the cash flows will be different for the two different periods. So all the cash flows traveling from 2018 to 2013 will be discounted with this cost of equity, which we are going to calculate. Let's first calculate that and then we'll talk about it. So cost of equity will be risk-free rate plus beta in bracket market rate minus risk-free rate. This is the formula for capital asset pricing model. Let's keep that in the Let's keep the values 6.25 plus 1.40 in bracket 5.5. Most of the students are going to make this mistake. They are going to write 5.5 minus 6.25 because they have assumed 5.5 as market return, and because that they were in a hurry to solve the question. Never do that in exam. Again, 6.25 plus 1.1 into 5.5. Let's solve it. 13.95%. 12.30%. So this is the cost of equity in the two different duration. For the first 5 years, all the cash flows traveling from 2018 to 2013 will be discounted with this cash flows, and all the cash flows traveling after that, after 2018, will be discounted with 12.30%. Make a note of it. Now the first question that we have been asked for is to find out the market price at 2018 at this point. Okay, so how are we going to do that? You can clearly see that after 2018, okay, the concept says that the market price, whether it is at 2018 or 2013 or 15, 16, 17, any point of time, the market price is calculated as the present value of future cash flows. Cash flows means the dividend per share. So the present value of future dividend will matter for the calculation of the market price. So if we are calculating the market price at 2018, do you understand that we need a dividend for the next year and the next year and the next year? So this comes under the perpetuity concept, and for that purpose we are going to calculate market price at the end of 2018 is equal to dividend of 2019. Am I right? In the perpetuity concept, we learned about this thing that if we are calculating a market price at a particular point, the cash flow should be of the next year, that is in 2019, divided by cost of equity minus growth. So 2019 dividend is this 2.91. Let's keep that. The growth is already included in that. Cost of equity 0.1230 and growth rate 0.06. You might say that the growth rate is not included in that, but yes, it is included in that. We are calculating a market price at this point of time. That means this includes the growth, the next year's figure. Okay. If you take 1.39, then you will have to add 6% growth rate, but that is not how the details are given in the question. The details says that the dividend for the next year should be 65% of the earning. So we have taken accordingly. And you remember this, we are discounting the cash flows from 2019 onwards, which comes under the cost of equity of 12.30%. So that's why 12.30% will be taken. Write down. .1230 minus 0.06 divided by equal to into 2.91. So that goes to 46.19. So this is a market price, 46.19 at this point. Now tell me, this is the first question. Now the second part says that calculate the market price of the equity share at 2013. How are you going to do that? It's very simple, sir. The concept is same. Present value of future cash flows. Market price at 2013 is going to be the present value of this 46.19 and this and this. Am I right? All the future dividends. So the 5 years dividend will be included here, and the dividend after 2018 for all the years are included in this 46.19. So discount these cash flows with 13.95%. This 46.19 is standing at 2018, and you have to take this cash flow from 18 to 13. From 18 to 13, that means this cash flow is now traveling from a phase where the cost of equity was 13.95%. So 46.19 will also be discounted with 13.95%. Do you agree with this? The procedure is simple now. You can do it by yourself. So I'm leaving it up to you. So this is the 46.19, and you can see 1 year, 2 year, 3 year, 4 year, 5 years dividend. 5 years dividend is this much, 3.54, right? And then the present value of 46.19. The total goes to 27.58. This is how you have to solve this question. Have a look on question number 37. 37 is homework. It is similar to 36. No, let me just have a look whether it is similar or something different is there. Yeah, it is a little different. So let's take that question now. SRK Limited is a listed company and it has just announced annual dividend for the year ending 2013 to 14. Earning per you can clearly see the current year is this one. Okay, before that the past year's data has been given to you. Now EPS and DPS. In the opinion of MD of SRK Limited, if current dividend policy is maintained, annual growth rate in earnings and dividends will be no better than the annual growth in earnings over the past year. What does that mean? It means that the future earning will grow by a rate and the future dividend also will grow by a percentage which was the same as the growth in the earning per share of the past years. So you first find out at what rate the earning per share did grow in the past years. The same rate will be applicable for the EPS growth and the DPS growth if the current dividend policy is followed. Since the board of SRK Limited, okay, let's not move ahead further. Let's first calculate the growth rate of EPS in the past years. So that is going to be question number 37, I suppose. See, how many years are there for which we have to calculate the growth rate? See, 2009-10, the EPS was 12.20. And from that point, 1 year, second year, third year, and fourth year. You might see 5 years there, but actually the growth rate which have to be calculated is only for 4 years. 1, 2, 3, 4. Because 9-10 is already over and 12.20 is at the end of the 2009-10 year. So let's calculate the growth rate for the EPS. And that will be calculated using a simple formula of compound amount is equal to principal in bracket 1 plus r to the power t, or future value is equal to present value in bracket 1 plus r to the power t. Sir, there is no n. Number of compounding in a year has not been taken in the formula because there is no multiple compoundings in a year. The growth rate will be annual. So the future value is 14 rupees and present value is 12 rupees 20 paisa. 1 plus r we have to find out to the power 4. In 4 years, this 12.20 rupees has grown to 14 rupees. You have to find out annual growth rate. So it's very simple, sir. 12.20 will be transferred on the left hand side. So 14 divided by 12.20 comes to 1.1475 is equal to 1 plus r. And that is 1 by 4. Since 1 by 4 can be written as like this, 1 by 4 is equal to 1 by 2 into 1 by 2, and every 1 by 2 is nothing but the square root. So when you do the square root, when you press the square root button 2 times, it means you have done this calculation. That comes to 1.035 is equal to 1 plus r. So r will be equal to 3.5%. This is going to be the growth rate. Now, if you follow current dividend policy, that means if you do not change any policy, no change in policy, and if we change the dividend policy, so there are few details that we should understand. First of all, let's take the growth rate. The growth rate will be 3.5% if you do not change the dividend policy. Now, have a look. Now we are going to change the dividend policy. Since the board of SRK Limited, have a look. Since the board of SRK Limited is reluctant to take debt to finance growth, they don't want to take outsiders' money just to finance this growth. It is considering changing its dividend policy by retaining 50% of its earning for investment in various projects. So the retention ratio is 50%, dividend payout ratio will also be 50%. Now what they are planning to do is they want to retain 50% of the earnings, and that 50% will be invested in various projects which will give us post tax rate of return of 15%, that will be ROI. So ROI is 15%, RR is the retention ratio is 50%. Can I say that I can calculate the new growth rate here? If we change the dividend policy, growth rates formula is BR, right? Where B is nothing but the retention ratio, R is nothing but the return on investment. The new retention ratio is 0.50 and the return on investment is 0.15. So the new growth rate will be 7.5% if you change the dividend policy. Now, what is going to happen? The beta of SRK Limited is 1.5. Market risk premium, underline the risk premium. It already means RM minus RF. You might make this mistake of treating that as market return. Don't do that. Risk-free rate is 6%. So with this, we can easily calculate the cost of equity. What is going to be the cost of equity? Cost of equity is RF plus beta in bracket RM minus RF, right? What is the risk-free rate of return? 6% plus beta 1.4 multiplied by 4, 1.5 multiplied by 4. Am I right? Yes. So the cost of equity will be 12%. Okay, that's great. Cost of equity has come to 12%. Let me just take this. The same cost of equity will be applied on this case also if you change the dividend policy. Okay, so we have the two data ready with us, growth and the cost of equity. Now let's write down D0. What is going to be D0 to start with if you do not change the policy? It's very simple, sir. The dividend of the last year, the current year, 8.20. It will become D0 here. Am I right? But what will be the D0 if you change the dividend policy? See, it's very simple. If you change the dividend policy, EPS is 14 rupees. And the new dividend will be EPS 0 multiplied by dividend payout ratio, 14 multiplied by 0.50. 50% is the retention. That means rest of the 50% is the dividend. That's 7 rupees. So the D0 for no change in policy is 8.2. D0 for change in policy is 7. Okay. Now, the question is asking you to calculate the market price of the share, which will be calculated with a simple formula of D0 in bracket 1 plus growth divided by cost of equity minus growth. So we need only three things: D0, growth and cost of equity. When there is no change in the policy, when there is a change in the policy, that's it. So we have to apply this formula twice. When there is a change in the policy, when there is no change in the policy, let's calculate first that. When there is no change in the policy, the D0 is 8.20, the growth rate is 1.035, cost of equity is 12%, the growth rate is 0.035. But when there is a change in the policy, the dividend becomes 7 rupees. Do you understand that? And the growth rate is 7.5%, 0.12 minus 0.075. That's it. Your answer is ready. Can you do the rest of the calculation easily? Can you do this calculation in one shot in the calculator instead of calculating the numerator first and then the denominator first and then writing the numerator and denominator? So you will just write down this divided by this and then make one more calculation. I'm asking you whether you can remove this entire calculation, whether we can reduce this particular we can say step. Yes, we can do that, sir. Have a look. This is just a calculator trick that you should know. See, start with the denominator. Solve that denominator and then convert that denominator into numerator. So what I'm going to do, have a look. In one shot, I'm going to calculate the entire answer. I am going to start with 0.12. I kept that in the on the calculator. Just one more trick. Let me, yeah, 0.12, just a second. Yeah. Then I'm going to press minus 0.035, okay, and then equal to, this is the denominator, but I'm not going to write it. I'm going to shift that denominator to the numerator by pressing divided by and equal to. What did I do? Divided by and equal to. So now this is the figure 11.7647. You can multiply the numerator with this figure also to get the same answer. And I know that 11.76 is now in the numerator, which has to be multiplied with the numerator. 8.20 multiplied by 1.035 multiplied by this. So multiplied by 8.20 multiplied by 1.035, and now press equals to. In one shot you have your answer, 99.85. This will reduce the time you spend in your exam for the same calculation. See, you are not going to get the marks for that one step, which you can easily remove, right? You can eliminate that. Also, there will be less miscalculation because you have not written anything. You are doing the entire calculation on the calculator itself. That's it. Great if you understood that. 0.12 minus 0.035 divided by into 1.075 into 7. That's, just a second, 0.12 minus 0.075 into 1.075 into 7. That's 167.22. So these are your two answers. If you change the dividend policy, the market price will be 167.22. If you do not change the policy, the market price will be 99.85. Let's just confirm, 99.85, 167.22. Great. Shall we move ahead to the next question, question number 38? And this is a great question. Have a look. The risk-free rate of return is 9%. The data is given to us. Let's write down. The risk-free rate is 9%. The expected rate of return on the market portfolio, that is RM, is 13%. So can I say RM minus RF will be 4%? Okay. Expected growth rate in the dividend is 7%. The last dividend, underline the word last dividend, that means this is D0. D0 is 2. The beta is 1.2. Okay. Now, what is the equilibrium price of the equity stock? You can easily calculate that with a, see. You have the D0 into growth, 2 rupees into 1.07 growth. And in the denominator, you need cost of equity. For cost of equity, you can use RF, RM and beta to calculate the CAPM rate or the cost of equity. So the first answer is very easy. See, first of all, you will put the CAPM formula on the given data to calculate the cost of equity. Your cost of equity will be 13.8%. And then you are going to use the Gordon's growth model to calculate the market price. This is very easy. Now the second part is something for which we have taken this question. How would the equilibrium price change if you are changing the inflation premium by 2%, if the growth rate is increasing by 3%, and if the beta is changing to 1.3. Now understand the wordings. Inflation premium is increasing by 2%. That means already there is some figure which has to be increased by 2%. Okay. Growth rate is already 7%, which has to be increased by 3%. That means the new growth rate will be 10%. The beta is already 1.2, but it will rise to 1.3. So that means it is only 1.3. See, it makes a lot of difference by these words, because of these words. If the beta of the Platinum Limited equity rises by 1.3 would have been written, then we would have added that 1.3 to 1.2 to make it 2.5. but it is not by 1.3, it is to 1.3. So this is 1.3. Okay, so these are certain changes. It is very easy to understand that, okay, the growth rate of 7% is becoming 10%, the beta of 1.2 is becoming 1.3. But what is this inflation premium and where we should adjust that? It's very simple, sir. Inflation premium is the extra return you need because of the inflation. So whatever the return that you are expecting, that is the cost of equity, which was I think 13 point something percent, 13.8%. Add 2% in that and the new required rate of return will be 15.8%. This is one way and the answer will be correct. But there are different methods which has been followed by the institute for this question in the past exams, RTP, MTP and so on. I have just written one answer and the second answer here, but there are 4 different answers given by the institute in the institute's material, and that will make you like you will get misinformed or you will get confused by looking at all those answers. What I have done is I have taken the latest answer by the institute, because that is what they suggest. First answer is clear. Now let's go to the second answer. What they have done, I will tell you. Okay, they have added 2% in 9. So the risk-free rate was 9% and the inflation premium of 2% was added in that. So 9 plus 2% is not 11. The one way of treating this 2% is making it 11%. But the another way of treating this is adding 2% of the 9% in 9. So making it 9.18. So this is what they have done, and this is also they have done in the alternative answer. See, 11%. So they are saying both the answers are correct. My opinion is this one is more appropriate than this one. Okay, one thing. They have taken the new beta. Cool. They have not changed any market return. So they have not taken the inflation premium in the market return, with which I am not that satisfied. Still, let's continue. So in the entire equation, in this entire answer, they have only taken the 2% impact on risk-free rate. Rest, this is the second change, 1.3 beta, and this is the next change, 10% of the growth rate. Rest of the figures are same. So since the risk-free rate is changing and the beta is changing, the new cost of equity will become 14.146, which will be kept here. And then you will find out the answer as 53.06. I'm not that much satisfied. So institute has given alternative answer where they have clearly mentioned that the 2% can be increased in the risk-free rate as well as the market return. So 9 plus 2, 11. The new beta, 1.3. 13 plus 2, 15. And this is printing mistake. It should be 11%. The answer is correct after this step. Instead of 8%, it should have been 11%. Please write down. I will just make sure I do the correction in the next edition. Okay. And the answer will be 16.20%. This is the new cost of equity. This will be kept in this formula of Gordon's growth model with the new growth rate, and you will get the market price of 35.48. Apart from that, what you have done in these two methods is that all the 3 changes have been taken at once. But someone might argue on this. Someone might also argue on this that, sir, what if the question is asking us to calculate the equilibrium price by taking only one change at a time? So take inflation premium of 2%, increase that and keep other things constant. That means the expected growth rate will be 7 and the beta will be 1.2 only. When you will take the growth rate as 10%, don't take this inflation premium, also keep the beta as 1.2. When you will increase the beta to 1.3, keep the growth rate to 7% and the risk-free rate and the market rate as same. So institute has given the alternative answer if you are assuming that one change has to be taken at a time. And this is it. If the inflation premium increases by 2%, this will raise the required rate of return from 13.8 to 15.80%, and the new market price will be this. You can clearly see that the growth rate is same because we have kept all the other things constant. If the growth rate is increasing by 3%, it will become 10%, right? And we have kept the cost of equity same because it is constant. If the beta rises to 1.3, then this is the new calculation. Just see, 9% is same, 13% is same, only the beta is changing, because of that the cost of equity changing, and the growth rate of 7% is kept constant. So all the other figures are have been kept constant and only one change has been done at a time, and we have calculated three different market prices. So if someone assumes that one change has to be taken at a time, this is the final answer. Let's move ahead. Now from this point onwards, you are going to face certain ambiguities in the questions. So I will tell you while I will be discussing this. So let's take a break of another 5 minutes and I will be back with question number 39. Okay, so let's discuss this. Your client is holding, this is a very simple question. Your client is holding the following securities. See, he has 4 different kinds of securities. The cost is 10,000, 15,000, 14,000 and 36,000. So we can calculate the total investment, which comes to 75,000, right? And the total dividend is also there, which comes to 7025. Then the market price, which comes to 80,500. If I deduct the market price from the investment, I will get the capital appreciation, which comes to 5,500. Why I am doing this is I want to calculate the portfolio return. Okay, and the portfolio return can be easily calculated as dividend plus capital appreciation divided by initial investment. The dividend becomes 7025, capital appreciation is becoming 5,500 divided by the investment, which is 75,000. The answer comes to 7025 divided by 75,000, 16.7%. Now what do you think this return is? 16.70% is the return of the portfolio, but in this question they are treating it as market return. Why? They are assuming this is the entire market, this portfolio is the entire market itself, and this is what the market return is. So practically speaking, I am not satisfied with that answer, but theoretically there are many such questions in the institute's material which has given the same treatment, and that's why for the marks purpose only we will have to do it if the similar question comes to exam. The average return on the portfolio is 15.7%. That is what we are going to take RP, but they have not specified it that this is this simple average or weighted average. They have not given this as an answer. According to me, the portfolio return is 16.70%. But yeah, this is also true that there cannot be two different portfolio returns in a single question. We cannot treat this 15.7 as a portfolio return and 16.70 also as the portfolio return. So since this is clearly given in the question, we have assumed 16.70, which is calculated in this manner, as the market return, first of all. Okay. Then the second thing is, they are asking us to calculate the expected rate of return in each using the capital asset pricing model. See, for the capital asset pricing model, we need 3 figures. That's it. First is the risk-free rate, second is the beta, and the third one is the market return. Market return is given to us since we have calculated. Beta is also given to us. The only figure which is missing is the risk-free rate, which is being asked in the second part. But we are going to calculate the risk-free return first and then the first part's answer. How to calculate the risk-free rate of return? It's very simple, sir. You already have the portfolio return. Put a capital asset pricing model formula for this. It will become 15.7% is equal to risk-free rate plus beta of the portfolio in bracket market rate, which is 16.7, minus risk-free rate. Now what is going to happen? You need only single figure, that is beta of the portfolio. Once you calculate the beta of the portfolio, you will be able to put all the figures in this equation and you will get the risk-free rate of return. How to calculate the beta of the portfolio, sir? Beta of the portfolio is nothing but the weighted average of all the betas. But since this 15.7 is taken as a simple average, if we can assume it as a simple average, if we assume that 15.7 as a simple average, we can take the simple average of the betas also. How to do that? 0.6 plus 0.8 plus 0.6 plus 0.01 divided by 4. That will be the simple average. But if we assume this 15.7 to be the weighted average, then we have to take beta of the portfolio also as the weighted average. How to calculate the weights? So 10,000 divided by 75,000. 15,000. 15,000 divided by 75,000. 14,000 divided by 75,000. Now tell me one thing. You will get the weights in such a manner. You have the beta given. Weight into beta will give you the portfolio beta, with which you will be able to calculate risk-free rate of return. Now you will have the risk-free rate of return and the market return as well, and the beta. Can you put CAPM formula in these 4 different securities and calculate the expected rate of return? Yes, sir, it's very easy now. So nothing is new in this question which has to be discussed any further. That's it. See, first they have calculated the details. With this, they have calculated the portfolio return. That will be called as the market return. And then they have taken the average of the betas. But they have also mentioned something special, that we can do the weighted average also. My preference is the weighted average. Okay. Once you calculate this 0.50, you can calculate the risk-free rate of return by putting a CAPM formula on the portfolio, which comes to 14.7, this RF. Now you have all the figures to calculate the CAPM return of the 4 securities. Just put a formula for 4 times, put the figures. 14.7 common, 16.7 common. The only figure which is changing is the beta, and that's why these are the return. These returns are called as the required rate of return. And these returns then will be compared with the actual rate of return. Now let me discuss one thing. Let's say, for example, the actual rate of return is 17%. So can I say that I am earning more in gold limited than required? Earning more in the gold limited than required. Why are you earning more? How come you earn more? Sorry. Because you might have purchased the shares at a cheaper rate. That's why the returns are higher. Returns are higher because the prices are lower. And if the prices are lower, it is called as undervalued. So the purpose of calculating these return is not given in the question. There is a further one more step. There is a step further that, which is comparing these returns, required returns, with the actual returns, and then finding out whether these are undervalued, overvalued, or correctly valued, and then taking a decision. If it is undervalued, buy the shares. Overvalued, sell the shares. Correctly valued, hold the shares. This is another question. Let's take. We are going to do it multiple times. This is the same question. 3 different securities and the Government of India bond. Initial price, dividend, market price. This is going to be the total of dividend. This market price and initial price will give you the capital appreciation. You can calculate the market return based on that. How to calculate the market return with which we are not satisfied, but we have to do it in this type of question. This is how you are going to do it. So this will give you the market return. Risk-free rate of return is given to you. Now you can easily calculate the CAPM return of all the 4 securities, because the only 3 things which is required, RM, RF and beta. For any CAPM return, these are the only things required. CAPM, risk-free rate of return is 16. Market return you will calculate. Beta is already given in the last column. You can calculate CAPM return of all the 4 different securities. Okay. So what is that they are asking? Expected rate of return on the portfolio in each of the above stated shares using CAPM. Once you calculate 4 different CAPM return, total them and take the average of that. They are saying average rate of return. So you can simply calculate average return. You can also do the weighted average, but for that purpose, you will have to calculate the weights based on these prices: 30, 40, 50 and 1000 and 5 initial investment. You can calculate the weighted average as well. See, dividend plus capital appreciation. This is going to be the market return, 25.87. Then you have the market return, risk-free rate of return given in the question, betas given in the question. You have calculated the CAPM return for all the 4 securities. Take all those and do the total, 23.38. This 23.38 can also be calculated with this method. See, portfolio return can be calculated with 2 different methods. Summation of weight I, RI. So you calculate the returns of all the securities and multiply it with the weight. You will get an answer. Otherwise also you can calculate the portfolio return by this method. Risk-free rate plus beta of the portfolio in bracket RM minus RF. So the only thing that you will have to calculate in this method is summation of beta I, weight I. My preference will always be to this method. Why? I will tell you. See, instead of putting for this return also, you will have to put 4 times CAPM return. CAPM, 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 CAPM. In this question, they have asked us to do that. That's why we did it. But if they would have asked only to calculate the return of the portfolio, then I would not have followed this method. Instead, I would have calculated the portfolio beta. So what I would have done is I would have taken the betas in the last column, multiplied it with the weights, and the average will be the portfolio beta, and that portfolio beta would have been kept here in the CAPM, and then this risk-free market. See, if all the risk-free rates are same here, there is a way to find out the answer by taking it just once. See, this much of the figures are same. The only figure which is changing in the equation is the beta. So take the betas only, average of the betas, and put 16 and 25.87 only once. We can do that. We are going to do it in the coming question. This is again the similar question. Have a look. 4 different securities. Cost, dividend, market price, and beta. Can you calculate the market return? It's very simple, sir. You will have to calculate the dividend and capital appreciation and divide it by initial investment. You will get the market return. True. The risk-free rate of return is given to you. True. The betas are given to you. True. You can easily calculate CAPM return of all the 4 securities, because the requirement of CAPM, RF, RM, and beta are all now with us. So expected rate of return on his portfolio using CAPM. There is one mistake in the question, not in the printing, but in the question. It says that calculate the portfolio return, but in the second part also, they are also asking to calculate the portfolio returns. How it is possible to calculate the portfolio return in both the cases? We cannot calculate the same answer in both the cases, right? The fact is, looking at the answer, you will realize this is okay. But the first part is not the calculation of return on his portfolio. It is the calculation of his return on the portfolio in each of the above share. This particular line is missing from the next question's statement. In each above stated share or bond. See, they have simply missed out this figure. So just write it down. I will do that. In each of above share or bond. Now it is very clear that first we have to calculate the CAPM return of the 4 shares and bonds, and then do the average of those. Simple. 4 and then average. See, another question. Question number 42. Let me just check. Yeah. Do you remember one of the questions related to JK Limited? Let's have a look on this question first. The year 2012, 13, 14, 15 is given to you. Krishna Limited's average price and dividend per share. Then the market average index and the market yield and the return on the government. They are asking us to calculate the beta. It's my mistake. I didn't keep this question with that one, the JK Limited. I will tell you. We have already solved this question by regression analysis method. I remember the question number is, I think, 19. Because after 15, there were 4 different questions related to beta, and the 4th one was only on the regression analysis. So this is related to that. An exactly similar question. Let's just go through that question first. So do you remember this question? See, again, there are 4 different years in this also. JK Limited share price, dividend per share, markets data also, average index and dividend yield, and this. And it has also been asked to calculate the beta for us. And we use the regression analysis. So follow the exact same method of question number 19 in that. I'm just going to write it as it is for your practice. I will also do some changes in the next edition. I will shift that question to question number 19. Then comes question number 43. Okay, so this is going to be another question, and this is going to be the same as the previous questions that we have seen, 2-3 questions. The better part in this question is that the CAPM return that we have been calculating in each of the securities will be extended further. It will be used. We will know the purpose of calculating that CAPM return. Have a look. These are the 4 different securities, the number of shares purchased, the geared beta of the each of the equity shares. Now, geared and ungeared have a particular meaning. The geared, what is geared beta, what is ungeared beta, all these things will be covered in the International Financial Management chapter. In this question, there is no use of the geared word. So that's why right now, because it is not related to the subject that we are discussing right now, we are going to postpone it for the International Financial Management. We are going to specifically take a lecture on the geared and ungeared beta in the International Financial Management, and you are going to love the concept and the derivation of geared and ungeared. So for now, just understand that this is a simple beta. Current market price is also given to us at which we have invested in each of the shares. Current dividend yield is also given to us, and the expected return. See, the dividend yield is given in percentage, right? So what you have to do is you have to find out first of all, okay, that's okay. Beta is given to us. See, risk-free rate of return and the market return are already there. Risk-free rate of return and the market returns are given already, and the betas are also there. So all the 3 figures required for the CAPM return is given. So we can easily calculate the CAPM return of all the 4 shares. Now, you are required to estimate the risk of Mr. A's portfolio relative to that of market. Risk here means the beta, because there is no information as such to calculate the standard deviation, because risk also means the standard deviation, and you might argue that why we are not calculating standard deviation, because there is no such information, sir, in this question. So the risk means the beta, and they are asking you to calculate the beta of the portfolio as compared to the beta of the market. Now you might say that the beta of market is, sir, 1. Why we have to calculate the beta of the market again? I will tell you in a moment. But let's first calculate beta of the portfolio. How to do that? It's very simple, sir. Weighted average. We have the betas of individual securities. Calculate the weight of each security. First of all, you will have to multiply the market price with number of share to arrive at the market value. And based on that market value, you will have to calculate the weight. So 1000 multiplied by 280, it will be 280,000. Then 340 into 1550. See, this is the column, market value. This is the weight. You will multiply the weight with the beta, you will get the concept. This is going to be the portfolio beta, 1.08 to be very specific. Okay, now let's find out whether the composition of portfolio should be changed. If yes, then how? Composition means, should we buy some shares or sell some shares or hold some shares? Any of the share, whether we need to buy something or sell something. We will get to know about the buying or selling of any of the securities only when we can compare the theoretical return with actual return, or we can say the required return with actual return, and the required return is calculated using CAPM. So one thing that you have to do first is calculate the CAPM return of all the securities. With that, you will get the required return, which you are going to compare with the expected return given in the last column. Okay, let's first calculate the required return. See, this is the required return. Okay, 21.50. 6% is the risk-free rate of return. How to calculate the required returns are RF plus beta in bracket RM minus RF. So put down for all the securities, you will get the required return. Put a next column as the expected return and find out the alpha. Alpha means the actual return minus required return. It will give you how much extra you are earning more than your expectation. Let's compare the first return. Your required return was 21.50 and the expected return is 21%. The market will be, the actual returns are this 21. 21.50 was just the return calculated based on a theory. So this is presented in your books only, but this is what you are getting in actual market, 21. And you can clearly see that you are getting less than what you are what you wanted, or what was the requirement is higher, you are getting lower return, and that's why the alpha is negative. Whenever the alpha is negative, that means we are getting lower than the required return. And if our return is lower, why it will be lower? Because we might be buying the share at a higher price or costlier, and that's when we can call it as overvalued, and overvalued shares should be sold in the market. Okay, let's compare the another one. Our required rate of return is 18.60 and we are only earning 18. Again, the actual earning is lower. Why? Because the price might be higher. Do you understand this concept? If the share is priced at a higher value, the return comes down. A market price is inversely related to the YTM. So if the YTM is lower, the yield or the return is lower, it is deemed that the market price is higher. And if it is higher, it is overvalued, sell the shares. Higher means overvalued, sell the shares. In this case, you can see your required rate of return is only 17.40% and you are earning more than that. Your return is higher because the price is lower. And since the price is lower, we will call it as undervalued and we will buy more shares. So undervalued and overvalued are never concluded on the returns, it is concluded on the price. So although we have to take the decision on the basis of return, but ultimately under or overvalued should be based on the price, whether it is lower or higher. This is again another same question, exact same question given to you. This is going to be your actual return. See, they have used the word dividend, but please understand this includes dividend plus capital appreciation both in this question, because otherwise there is no other percentage. So this actual return is again should be compared with the required return, which will be calculated using CAPM, and for that only three things are required: risk-free rate, market rate, and beta. See, betas are given to you, market return is given to you, and risk-free rate of return is given to you. So use those three return in CAPM formula of all the securities, calculate the required rate of return, compare it with the actual return, and then find out whether it is overvalued, undervalued, or correctly valued. See, the story will be like this now. Question number 44. Instead of solving the same question, we should focus more on the story. So, if you want to buy the share, sell the share, or hold the share. If you want to buy the share, it should be undervalued. If you want to sell the share, it should be overvalued. If you want to hold the share, it should be correctly valued. Okay. If the shares are undervalued, we will call it as a market price is lower, market price is higher, equal, or same, as required. When we call market price is lower, it means returns. Actual returns are higher. Is higher. Actual return is lower and actual return is same, right? In other words, we can write down actual return is greater than required return, actual return is less than required return, and actual return is equal to required return. This required return can be calculated with a single formula called as capital asset pricing model. For that purpose, the formula is RI is equal to RF plus beta in bracket RM minus RF. All the three figures. So you only need 1, 2 and 3 figures. If you have been given with this data in the question, simply calculate RI for all the 4 securities, then compare it with the actual return and find out in which case it fits, then decide whether actual return is higher, lower or same. Based on that, it will be opposite. The market price will be opposite. If the returns are higher, that means you are buying the shares at a lower price. If the returns are lower, you are buying the shares at a higher price. If the market price is lower, it will be called as undervalued, buy the share. If the market price is higher, it will be called as overvalued, sell the shares. Are you okay with this? Okay, let's move ahead to the next question. Homework, similar type of question it is. Need not be taken again. See, this is just like JK Limited. Do you remember JK Limited and Krishna Limited? In that, beta was asked. So first they are asking us to calculate the return of X, then the market, and then the risk-free rate of return and the beta of X. Risk-free rate of return, average return is this much, right? So please understand, you can delete this question first of all. Why delete this question? I will tell you. The methods that has been used here is not used in the latest material of the institute. This is RTP November 2011. That is 11 years back, I think, right? 11 to 12 years back. This question was asked in the RTP. And see, I will tell you, in the capital gain, they are taking only 4 years, and in the dividend, they are taking 5 years. So this return is based on 4 year, this return is based on 5 year, and both of them are being added. And they have been, it has been 30%. So I am not satisfied with the answer. The first answer, capital gain, is calculated on a compounded basis. The dividend yield is calculated on an average basis. You can clearly see that. So also I am not satisfied with the answer. So in total I can say that in a summary I am not satisfied with the answer. But a similar type of question was asked after this 2011. So we have question number, I think 19. And I think 42 or something on the Krishna. So both of the questions. So follow that approach, delete this one. I am also going to delete this entire question from the next edition of the compiler. I think we have to delete one more question. Yeah, this one also. Why? Because it also follows the same method. See, average capital gain based on the compounded method, 4 years, right? And then the annual dividend is being calculated like this, divided by 5. Again the same thing. So delete both these questions, only follow the previous two. So I'm just shifting to question number 48. Okay, so let's have a look on this question now. This is going to be very easy question. Tempest has the following portfolio of 4 shares. So he has made a portfolio. Portfolio is nothing but a combination of various types of securities, 2 or more than 2 securities. So there are 4 different shares in his portfolio: Oxy, Boxed, Square and Ellipse. The beta of all the 4 shares have been given to us. Investment made in all the shares are also there. So we can clearly see that the total investment comes down to 0.8 plus 1.5 plus 2.25 plus 4.5. Okay, that comes to 9.05. Now, what else is given? The risk-free rate of return is 7% and the market rate of return is 14%. We can easily calculate the CAPM return of all the 4 shares, but it is not required. Determine the portfolio return. See, portfolio return of the portfolio. It can be calculated through 2 different methods. First, you can just take the weights of each of the security and calculate the return of each of the security. If you will try to calculate the weights of each of the security, let me tell you how to do that very easily. So let's find out the weights based on the investment. Now you tell me one thing, just a second. Now you tell me one thing. In order to calculate the weights, you will do this calculation. 0.80 divided by 9.05. Then again 1.50 divided by 9.05. Every time you will press divided by 9.05. This is going to increase the time you are spending, first of all, on the entire calculation. You will get lesser time to solve all the other questions in exam, and there are chances of miscalculation, because the more number of keys you press on the calculator, there are higher the chances that you will make the mistake. So instead, we know that 9.05 is a common factor which is coming every time in the denominator. We can keep that in the memory and keep on pressing only this much of the figures. Yeah, we can do that. See, let's do it. 1 divided by 9.05 and then press equals to and then multiplication. So basically we have shifted the denominator to the numerator, inverse of that, and kept it in the memory, and then multiplied by 0.80, multiplied by 1.50, 2.25 and 4.5. Have a look how to do that. So you have the calculator. Can you see the calculator now? Okay. So the buttons that I'm pressing right now is just have a look on that. 1 divided by 9.05 equals to multiplied by. That means now this much of the figure 0.11049 or 5 will be multiplied every time with all the figures of investment. 0.8 equals to 0.0884. 1.5 equals to 0.1657. 2.25 equals to 0.2486. 4.5 equals to 0.4972. See, I just pressed only those keys which were variable in nature, and the same figure 1 divided by 9.05, the constant figure was always there at the back of the calculator in the memory. So I didn't have to press it again and again. So see, 0.80 divided by 9.05, 1.50 divided by 9.05. You just imagine pressing those keys again and again. That's how the shortcuts are there for the calculator, and you can save time. What you have to do, again, I will just write it down on the calculator. 1 divided by 9.05 equal to into, then 0.80 equals to 1.50 equals to 2.25 equals to 4.50 equals to, you will get the answers. Okay, so weight has been calculated. Now how to calculate the return? Return can be calculated using CAPM formula. Ri is equal to Rf plus beta I in bracket Rm minus Rf. But you will have to calculate that CAPM. You have to put the CAPM formula 4 times to calculate the 4 different returns, then multiply it with the weights and then total it to arrive at the portfolio return. Another way of this is to calculate the portfolio return using CAPM directly. For that purpose, portfolio return is equal to risk-free rate of return given in the question plus portfolio beta, the only thing that we have to calculate. So portfolio beta now. Portfolio beta, summation of weight I, beta I. See, beta is already given to you. What was happening in this CAPM return? You had to calculate the return according to CAPM first and then multiply with the weights. But the betas are already given to you. Just take those beta, multiply it with the weight. You will get the average. You will get the weighted average portfolio beta. Put it only once in this CAPM, not 4 times, only once, and you will have the portfolio return. So my question is, first, my take is, first calculate the portfolio beta using weighted average, because anyhow it has been asked to calculate. If you follow this method now, first one, it will take a longer time, more time basically to solve the question than if you start with this method. So first find out the portfolio beta, put that portfolio beta in a CAPM return and you will get the portfolio return. Okay. I will just tell you, don't follow this method. First, calculate the portfolio beta. Start from here. I will tell you. Just do this much. Do not for exam. This is not for exam. Just start from the here portfolio beta. Calculate 1.30 and put that 1.30 in the CAPM. Okay. Just a second. Not from here. Start from here. Calculating the portfolio beta, and then on the other side put it in the CAPM. Put that 1.3035 in CAPM. You will get the answer. So portfolio beta and portfolio return has both the same formula, that is weighted average return. Question number 49. Have a look. Again, we will have to calculate the portfolio beta in this question, which will be nothing but the beta of the individual assets and weight. So we'll have to focus more on the betas and weights. Have a look. The total market value of equity shares of ORE company is 60 lakhs. This is the value of equity share, 60 lakhs. And the total value of the debt is 40 lakhs. So you can understand, this is the company. Equity is 60 lakhs, debt is 40 lakhs. So the weights are also 0.60 and 0.40. Weights are ready. Now, the treasurer estimate that the beta of the stock is currently 1.5. Instead of this, I will just write down it into a table. See, this is equity, this is debt, amount. In amount, it is 60 lakhs and 40 lakhs. So therefore, the weights will be 0.60 and 0.40. The beta of equity is given to you, which is 1.5. And that the expected risk premium, underline the word premium, it is already RM minus RF. This 10% is already RM minus RF. The treasury bill rate is 8% RF. Okay. Now, what has been asked? What is the beta of the company's existing portfolio of asset? What do you think the portfolio consists of? Equity and debt. So the total portfolio is of 100 lakhs. And you have to calculate the portfolio beta, which is nothing but the weighted average. And weighted average will be calculated as this. See, you have to take the weight of 0.60, multiply it with 1.5, you will get 0.9. But there is no beta of debt given in the question. And that's when you are going to assume that the debt in the company is assumed to be practically riskless. And that's why the beta of debt is taken as 0. Why? Because you are assuming this as riskless. If there is no risk, there is no beta. See. Note, since beta of the debt is not given, it is assumed that the company's debt capital is virtually riskless. And if it is riskless, then the beta comes to 0. Right? And if it comes to 0, the portfolio beta will be 0.9. 0.60 into 1.5 only. So this is your first answer, that the portfolio beta will be 0.9. Now, estimate the company's cost of capital. Capital. Not equity, not debt, capital. And the discount rate for expansion of the company's present business. So, I'm just writing it here. If equity is there in the company, see, if you want to calculate the cost for equity, it will be called as cost of equity. Cost for debt, it will be called as cost of debt. But if you want to calculate the cost for entire company, it will be called as cost of capital. Right? So instead of that, what we denote is the KO, and it is of the same pattern. KO can be calculated using two different methods. Understand? One is called as CAPM. KO, required rate of return, is nothing but RF plus portfolio beta. See, cost of total capital means, see this portfolio. Total capital is of 100 lakhs and 100 lakhs is itself a portfolio, and the portfolio beta is given. So portfolio beta RM minus RF. You can easily calculate the cost here. But you can also calculate using weighted average cost of capital, that is called as WACC. So in that part, what you are going to do, whatever is included in this capital, you are going to take that capital and multiply it with the weight. So it will be cost of equity into weight of equity plus cost of debt into weight of debt. Try calculating through both the methods and you will get the same answer. See, Let's find out the market risk premium, which is 10. See, 8% is the risk-free rate of return. Portfolio beta we just calculated was 0.9 and the premium is 10. Market risk premium is 10. So that entire RM minus RF is 10%. So 10 into 0.9 is 9% and 8, that gives you the answer as 17%. Okay, let's find out the through WACC method. See, we already know the weight of the equity and weight of the debt. Okay, weight of the equity and weight of the debt is already known to us, which is 0.6 and 0.4. The only thing which is not known to us is cost of equity and cost of debt, which we can calculate through CAPM. Obviously, this cost of capital also is being calculated through CAPM. We can also calculate this cost of equity and cost of debt through CAPM. Let me write down. Cost of equity is equal to 8% risk-free rate of return plus beta of equity 1.5 into 10. So that's 23%. Cost of debt 8%. What is the beta of debt? If you have to calculate cost of equity, put cost of beta of equity. Cost of debt, put beta of the debt. Beta of the debt is assumed to be 0 into 10. So that goes to 8. Okay. Now we have cost of equity and cost of debt both. Let's find out. Cost of equity is 23% multiplied by 0.60 is the weight of equity. Cost of debt is 8% multiplied by 0.4. So if you will do the calculation, 23 into 0.6 goes to 13.8 and this goes to 3.2 and the total is 17%. So you calculate it this way, you calculate it this way, you will get the same answer. I am purposefully doing it in the compiler itself. Don't you think that the cost which is calculated in this part using WACC means weighted average or the CAPM is similar to the part that we have discussed here, return on the portfolio using weighted average or CAPM. In this part also I told you go through the CAPM method, the second method. This will save your time, and in this part also go through the CAPM method. This will save your time because we had to apply the CAPM return twice in this approach and once only in this approach. Anyhow, 0.9 was calculated by us, the portfolio beta. Why not to use that for further calculation? So 0.9 is the answer and 17% is the answer here. Okay, this is the homework related question. It's very simple. Portfolio beta has been asked to us, which is nothing but summation of weight I, beta I. Simply weight, here it will come to 20% in each investment multiplied with the beta, you will get the portfolio beta. In the second part, the weights are given. So these are going to be the proportion, beta, multiply, and you will get the answer. Simple. In the third part, they are saying that if the market return is 12% and the beta is this much, how much will be the securities return? 14.5. Just multiply the beta. See, market return is 10% and the beta is 1.2, then what will be the securities return? 12%. That is what we learned about the beta. If the risk is higher in the security than the beta, then the return will also be higher. Same is happening. That's it. Question number 50 it was. Now I will take a break and then I will start with question number 51. See you. So welcome back after the break, and now we are going to start with question number 51. This question is pretty easy and it won't take much of the time. Have a look on this question. A Limited has an expected return of 22% and standard deviation of 40%. See, there are two different securities in this question and all we have been asked to calculate is the portfolio return and portfolio risk, in which security we should invest, in which we should not. So this question is quite easy. Let's first write down the details given in the question. This is A, this is B. So we will have the return of both the securities, standard deviation of both the securities, betas of both the securities, correlation coefficient between the two as well. Okay, the return 22 and 40%, 22 and 40% in A and 24 and 38% in B, then 0.86 and 1.24. 0.86, 1.24. The correlation coefficient between the two is 0.72. If you take the market here, the standard deviation of the market is 20%. Okay. Now, the very first thing that the question is asking us, is investing in B Limited better than investing in A Limited? Of course, why not? You can see the return of B Limited is higher as compared to A Limited, and the risk of B Limited is lower as compared to A Limited. Right? So, in both the cases, security B should be preferred. Although the risk, the beta, if you go through the beta, A is preferable because it is carrying a lower systematic risk. But two of the factors are preferring security B. So yes, investing in security B is preferable as compared to A. So the answer for the first is that investing in B is better than in A. Now, if you invest 30% in B, understand the first ratio weight that has been given in the question is for B Limited. Most of the students will make this mistake. Whenever they will write the weights, they will write it like this: 30 and 70, because 30 is given first and A comes before B. This is human tendency. You will end up writing 30% in A, whereas they are saying 30% in B and then they said 70% in A. So A was referred later. So 0.70, 0.30, this is correct. That is where you may end up making mistake and still feel confident that you have solved the question entirely correct. After the exam, when you come after the exam and you realize that when after the results you realize that my paper was very good, why I have received so much of the less marks. So these are the reasons. So anytime you feel you are not getting proper marks, go ahead and make sure you call the scanned copies of your mark sheet or answer sheet and analyze that. Go through it, you will realize where you are making the mistakes. Okay, then the next part is, what is your expected rate of return and portfolio standard deviation? Now, we have been given with the weights. First thing that they have asked us is the portfolio return. Can we calculate summation of weight I, RI? We have the returns of both the securities A and B and the weights also. So this is going to be easy. Then third part, standard deviation of the portfolio. Is it easy for us? Yes. Only, what is the formula? RA. Standard deviation of A, weight of A square, plus standard deviation of B, weight of B square, plus 2 into weight of A, weight of B, standard deviation of A, standard deviation of B, RAB. So all in all, you need only 5 figures and everything is there in the question. You have the standard deviation of both the securities, weights of both the securities, and correlation coefficient also. Every figure is there. Just put down the figures in the answers formula and you will get the answer. I'm just going ahead. See, I'm not going to discuss things where the situation is only put values in the formulas and then do the calculation. I don't know. I don't think that I should be explaining that to you, because this is all about the practice. If you want to learn 2 plus 2 is 4, then you have to do the practice, because this is all mathematics. Why 2 is taken is my area where I will be explaining as a teacher for SFM. Okay. What is the market portfolio expected rate of return and how much is the risk-free rate of return? See what they are asking us. The standard deviation of the market is 20%. They are saying what is the market portfolio expected rate of return. They are asking us to calculate RM and RF. How it is going to be possible? Yes, if it is possible, yes. See, I will show you. The third part. It's very simple. Take security A and write down the formula. RI is equal to RF plus beta in bracket RM minus RF. Okay. The return for security A is 22%, right? And risk-free security is unknown. Beta is 0.86 and RM minus RF is unknown. This will become your equation 1. Then you take the second security 24 RF plus 1.24 RM minus RF. Now you can solve the equation and you will get the answer. But what is exactly that we should learn from here? The question. It is all about the question. See, when they are asking you to calculate market return and risk-free rate of return, you should understand that if there are 10 securities in line, the market return and risk-free return will be same for all the 10 securities. Market return and risk-free rate of return will be same for all the securities. If you have to calculate the CAPM return for all the 10 securities, these two factors will be same, right? So we can interpolate these answers from any of the two securities. That's what we are doing. A and B will carry same RM and RF in their equation. So that's why we have taken it in the equation form, and from this we will get to know what was the common figure. So let's deduct equation 2 and equation 1. 2 minus 1, not 1 minus 2, 2 minus 1. Even if you do the 1 minus 2, the calculation will be like minus minus signs, but you will end up getting correct answer. 24 minus 2 is 2%, RF get cancelled, plus 1.24 minus 0.86. 1.24 minus 0.86. So it will be 0.38 RM minus RF. Now if you will solve this equation, RM minus RF will be 2 divided by 0.38 means 5.26. Now you can put this RM minus RF in any of the equation. Let's put it in equation 1. So 22% is equal to RF plus 0.86 is the beta and 5.26 is the RM minus RF. From this part you will get to know about the RF. 0.86 into 5.26 minus 22. So that's 17.48. 17.48 is the RF. So RM minus 17.48 should be equal to 5.26. That's what we found. So RM is equal to 22.74. So these RM and RF are with you. The thing that I want to explain here is not the calculation or the correct answer, is the idea that should come in your mind how to calculate. Whenever you have to calculate RM and RF, please understand that these are the two figures which are common in every CAPM equation. So yes, I took all the CAPM equation that I could make from this entire question, and then I realized that yes, we can calculate RM minus RF and RM and RF individually as well. So this is how you have to do it if in future any question comes on it. Okay, let's move ahead. What is the beta of the portfolio if weights? See, this is what you can easily calculate. The beta yeah, the beta 0.86 and 1.24 are given to you, and the weights are also given. For A limited 70%, for B limited 30%. So just make the weighted average. It's very simple. Beta of the portfolio is summation of weighted average. We have done this question, so that's why I'm moving ahead. Now, this is question number 52, and let me tell you one thing. You have done this question already. 52, 26. I think 26 was the question. See, equilibrium return, market return, since both the returns are same, we can say that the beta of this stock is 1. Also 7% treasury bond, covariance, coefficient of correlation. You have been asked to calculate standard deviation of the market and security. If you remember, there was one question I will tell you. Do you remember this question, question number 26? you are required to determine the standard deviation of market return and security return. So this was asked in November 2016 for 5 marks. Exactly same. Instead of 15% return, there are equilibrium return and market return of 12%, 6% covariance, correlation. Everything is same. So it is as good as 26. Let me just move ahead. This is going to be a practice question for you now. Shift to question number 53. Let me just check. Yeah, have a look. An investor holds two stocks, A and B. What has been asked to calculate? Good, this is a very good question, I think, because from the very first formula of calculating the security return till the end of using the CAPM, whatever we have learned till now will be used, maximum part of that will be used in this question. So this is the question that I'm going to solve thoroughly in the class. Have a look. So let's read this question. There are two securities A and B, and the third security, which is given as C, is not exactly the security, but it is a market. Now understand that there are three different probabilities given to you in the question with the returns of the market and two securities. Okay, the risk-free rate of return which is expected to be there in the next year is 11%. Determine whether investor should liquidate. Underline the word liquidate. It means sell. Whether investor should sell A and B, because he is already holding the stocks of A and B, means he has already invested in those shares. Now the question is whether I should sell those shares or instead buy more of them. And how to decide that? What is the chronology for this? It's very simple, sir. We have to decide whether to sell or buy. We will sell when the shares will be overvalued. If it is undervalued, we will buy it, right? And overvalued and undervalued will be decided. Undervalued. If the actual return is greater than required return, or I can say CAPM return, then it will be called as undervalued. Because if the return is higher, the price will be lower. Or let's bring one more step in between. Overvalued is when the price is higher. Undervalued is when the price is lower. And if the price is higher, actual return should be less than CAPM return. And if the price is lower, actual return should be greater than CAPM return. Actual return can be calculated easily with a formula of summation of return into probability in this question. So what you are going to do, multiply the probabilities with the securities return and you will get single figure, that will be the actual return. But then you have to calculate CAPM return. How to calculate CAPM return? Sir, it's very simple. Ri is equal to Rf plus beta in bracket Rm minus Rf. Now understand, in this particular equation, Rf is already given to us. Rm can be calculated. Again, Rm can be calculated with the help of this formula. So actual return of A and B and market return can be calculated with this formula, probabilities multiplied by the return. See, all the probabilities are given to you and the returns are also given in the respective column. Okay, now the only thing left to complete this chronology is the calculation of beta, and beta can be calculated using a method called as covariance. Acha, let me just complete it. There are two different methods of calculating beta of security A and security B. So beta can be calculated using regression analysis or correlation analysis. In this question, we will go with the correlation analysis because the probabilities are given first of all and it is more logical. So correlation analysis is covariance of A with C divided by standard deviation of C square. And the same you are going to do with security B, covariance of B with C and standard deviation of C square in the denominator. Now, First you will have to calculate the covariance. How to calculate the covariance? How to calculate the covariance? I think I should write down this entire chronology because yeah, we have a space here. So there are two things now we have to calculate. Covariance. It's very simple, sir. Covariance is nothing but return of RA minus bar RA, means the deviation of returns of security A multiplied by the deviations of returns of market into probability and then summation. This is the covariance of AC. In the similar way, you can calculate the covariance of BC. Then comes the standard deviation of C square. How to calculate the market variance? Very simple, sir. RC minus bar RC. This is the deviation of market. Then square it to remove the negativity. Then multiply it with the probability and then do the summation. And now everything is given to you. You will start your answer from this point. First take the security A, then B, then C. Calculate the deviation of both the securities A and B, then calculate the standard deviation of market. And then start with this product, calculate the covariance first, put it here, you will get the beta, then calculate the CAPM return, compare it with the actual return, then decide whether to buy or sell. So this is going to be step-by-step method for this question. Okay, you are going to follow this. Let's have a look on the answer now. Now it is going to be very much clear. I think now it is very much clear in your head. Okay, expected return is the probability. So what we are going to do, we are going to multiply the probability. See, 40% into 25, 30 into 10 and 30 into 0.5 negative. So this is 11.5%. This is RA, bar RA. And the same we did for the security B. This is bar RB. Then the same we did for security C. So this is bar RC. Then we calculated the variance of the market with this formula of RC minus bar RC square probability and then summation. This is the variance of the market. Then covariance of A with market. So this is AM or AC. That is what we were talking about. Return of A minus bar RA. Please understand, you should be able to read it. Return of M minus bar RM into probability and then summation. They have done the entire answer, written the entire answer in an equation format. My suggestion to you is go with the table format in this case. This will help you to solve the to find out the correct answer and help you to reduce the chances of making a mistake, because there are some negatives in this question. See, minus 5 minus 11.5 into minus 3 minus 10.5. What happens in this case is there are maximum chances that you will make a mistake when you start with this equation format. So my suggestion, go with table format. It will give you a proper presentation, right? And you have to calculate all these things. See, question number 53. Let's take A first. And you can keep the entire calculation very simple. First, I will take the probabilities here. 0.40, 0.30, 0.30, I think. Yes. Okay. Then I will take security A. So this is going to be RA. How much? 25, 10 and minus 5. See, 25, 10 and minus 5. I am just writing because I want to show you what should be the format. Then RA multiplied by probability. This is going to be 10, 3 minus 1.5. And the total will be 11.5. Then we are going to do, this is going to be bar RA. Then RA minus bar RA, that means the deviation. Okay. So 25 minus 11.5 equals to 13.5. 10 equals to minus 1.5. 5 plus minus equals to minus 16.5. See, I know that I have to deduct 11.5. That's a common figure out of all the three. So what I did on the calculator, understand, I will put 25, then press minus sign, then press 11.5, then equals to. So I will get the first answer, that is 13.5. Okay, then I will press 10 equals to, then I will press minus 5 equals to, and I will start getting the answers. At this point I will get 13.5, at this point I will get minus 1.5, and at this point I will get 16.5 negative. Automatically, you don't have to press 11.5 again and again and again. Okay, the same you will do with the B, but I'm not writing the answers for B. I will just solve it for security A. The same will be the calculation for security B. So this is it. Now let's find out the details for C. 0.40, 30 and 30. These are the probabilities. Returns 18, 13 and minus 3. 18, 13 and minus 3. Let's multiply. 7.2, 3.9 and minus 0.9. 10.2. So let's calculate the deviation now for C. RC into probability, and RC minus bar RC. This is your bar RC. 18 minus 10.2 equals to 7.8. 13 equals to 2.8. 3 plus minus equals to minus 13.2. See, here you will have to do some changes. It is 5 and then you will press plus minus, so it will make the 5 as negative, and then press equals to. Right, now we are going to square this. Why we are squaring this? Because we want to find out the variance of market. 7.8 into equal to 60.84 m plus 2.8 into equal to m plus 7.84, and 13.2 into equal to m plus 174.24. MRC 242.92. This is entirely wrong answer. Did you realize what I was doing? I was doing everything in a right manner, but I forgot to multiply with the probabilities. Multiply this 7.8 square with the probability. So that might also happen with you. I did not do it purposefully. That was my mistake in the answer, and I realized it by the end of the calculation, and that's why immediately I told you that this is a mistake. So let's just clear all the MRC and let's repeat it. 7.8 into equal to into 0.40 m plus 24.34. 2.8, the second deviation, into equal to into 0.3 m plus 2.35. Then 13.2 into equal to into 0.30 m plus 52.27, and MRC 78.96. This is your variance, market variance, standard deviation of C square. Okay, now let's find out the beta. Okay, sorry, covariance. For the covariance we need, see, I will just do it here. RA minus bar RA into RC minus bar RC into probability. So what are those three columns? I will tell you. This is the first column, this is the second column, and this is the third column. Multiply this to get the covariance. Am I right? The deviation of A with the deviation of this multiplied by probability, and if there is no probability, you will divide it by n. 13.5 into 7.8 into 0.40. 13.5 into 7.8 into 0.40 m plus 42.12, 1.5 plus minus into 2.8 into 0.3 m plus minus 1.26, 16.5 m plus plus minus 13.2, sorry, 16.5 plus minus into 13.2 plus minus into 0.3, so that's 65.34. The total is 106.2. This is the covariance. Now let's find out. Beta of A is nothing but covariance of AC divided by standard deviation of C square. 106.2 divided by 78.96. Am I right? Is equal to 1.34 is the beta. Now cost of equity, or we can say CAPM return for A, is risk-free rate plus market to plus beta of A, market return minus risk-free rate of return. So understand, risk-free rate of return, how much is that in the question? 11%. 11% plus beta is 1.34 that we just calculated. Market return 10.2 minus 11, you will understand. Risk-free rate 11% and market return 10.2. Wow. So for the first time we are seeing such questions, right? 11 minus 10.2 minus 11 into 1.34. So that's minus 1.072. And your return is 9.93%. Now this is your CAPM return. What is your actual return? Actual return was 11.5%, right? Actual return was 11.5%, which is greater than CAPM return 9.93%, which is greater than CAPM return 9.93%. We can clearly say that if the return is higher, the price will be lower. So shares are undervalued and hence it's worth to make fresh investment in that. This is how every step will be. In the next calculation, when you will be doing it for security B, you don't have to calculate the standard deviation of variance of market. You can simply calculate this much of the data and then shift directly to the covariance of BC, B with the market, and from that this point onwards everything will be same for security B. Do you understand this process? This entire process step by step is written over here. I will upload this document in the app also. You can go through it anytime. See, 9.92, 9.92, almost both the securities are underpriced and hence we should make a fresh investment in them. That's the conclusion. Good. I'm keeping this question for you. See, why I will tell you. There is a company C Limited and the market. The probabilities are also given to you. Okay. So can you calculate the coefficient of correlation between C and the market? You need to first understand the formula of coefficient of correlation. Is very simple. It says how much is the risk in actual when we create a portfolio as against the individual or a separate risk. So it's very simple. Covariance of C and M divided by standard deviation of C and standard deviation of M. Understand that it's almost variance in the denominator as well, variance in the numerator as well. This is the variance this is the risk when we keep both the things separately, or when we look at both the things separately. But when we look at both the things equally or combined in a portfolio, this is the actual risk. If the actual risk is, let's say, 80 and the separate risk is 100, the relation will be 0.80. That means the risk is getting reduced. You can calculate that. Covariance is very simple. We have just calculated the covariance. Standard deviation we learned in the very first question itself. So I think this is going to be easy for you. Now, total risk you will already, you would have calculated in this part. This is going to be the standard deviation of C, because you need it for this calculation. For the correlation calculation, you already need standard deviation of C, and that is nothing but the total risk. Okay, now the question comes, why this is not the most appropriate measure of risk to be used in making investment decision? Why do you think this total risk or the standard deviation is not appropriate measure? I will tell you. This total risk is divided into two parts, systematic risk and unsystematic risk. Okay. Now the theory says that, or the practical life says that, this unsystematic risk can be diversified. What does that mean? It can be eliminated. Not eliminated exactly. We can reduce that risk. We can reduce that risk to a maximum extent. So if an investor is investing in a particular stock, he should reduce the unsystematic risk of that stock by diversifying his investment in different types of industries and securities. Okay. And let me tell you one thing. If unsystematic risk can be reduced to zero, or can be reduced maximum or approximately to zero, then there is no premium that should be paid in bearing this risk. If you are creating a portfolio and not reducing the unsystematic risk, the market says that that is your problem. You should have done that. And if you're not doing it, you are not going to get any type of market premium. So the basically speaking, this is in our control, unsystematic risk, and can be diversified. So an investor should not be worried about how much is my risk in, how much is my unsystematic risk in this particular stock, because anyhow I can eliminate that unsystematic risk. So it makes no point in calculating or making efforts to know that, to find out that, right? What we cannot control is the systematic risk, which is measured by beta. This is not in our control. So in every investment we'll have to find out how much is the systematic risk, because this is something we will be worried about. And that's why the proper measure of risk seems to be systematic and not the total risk, because total risk includes unsystematic, which is not important. That's what the meaning is. This is not the best measure for taking investment decision because it contains unsystematic risk. Underline the word unsystematic risk. The moment you will revise this question again and you will come to this point, by just reading this particular word, it will strike to you that, yeah, I know the reason why total risk is not considered to be the best measure of risk. Okay. That was the second part. Then the third part, calculate the beta factor of C limited. Can we do that? Yes, sir, we can do that. Beta is calculated as beta is equal to covariance of CM, this covariance of CM and variance of this standard deviation. So all the figures that you need in the third calculation will already be available in the first part. Okay, and briefly discuss its significance. Is C limited efficiently priced according to the CAPM and the information given above? I will tell you. You calculate the actual return by multiplying the returns of C with the weights, just like the previous question. And then since you are already calculating the beta, put that beta in CAPM. For that purpose, you will need beta. You will need this beta. You have it. The market return, you can have it from here. Market return into probabilities, and the risk-free rate of return is already given to you. Then compare that CAPM return with this actual return that you have calculated, and then assess whether it is overvalued or undervalued. See what has happened here. We have calculated the beta, then we calculated the CAPM return with 17.46 as the required rate of return. We wanted this much of the return, and the actual return was, or expected return that we are supposed to earn in this is 19, which is pretty good figure, because we wanted lesser than that. We are able to earn more returns. That means we are able to buy the shares at a lower price. That's why the return is going up, right? And that's why it is worth buying. It is in order to find out whether the stock is efficiently priced or not. Stock is not efficiently priced, and that's why it is undervalued. If it is efficiently priced, it would have been correct valuation. Question number 55 is going to be an interesting question. See, question number 55 is something which has been asked in a tricky manner. Although everything in this question has been learned by us in the previous part, but you will find a little difficulty in solving this question because the wordings used here are not A share, share ABC, or four different types of shares. Instead of using different types of shares like A limited, B limited, C limited, they have used the words of car air conditioner, window air conditioner, and split air conditioner. So you will have to look at these air conditioners from the angle of the companies, A company, B company, C company. And if a particular company is manufacturing all these three air conditioner, that means that company is the portfolio which has included these three air conditioners. This is how you will have to look at this question in order to solve it. So this is going to be an interesting part. Let's have a look at that. Okay, ABC Limited is a manufacturer of car AC, window AC, and split AC. I will just give you some data here to make this calculation easy. 55, right? So there is this company ABC, and there is another company on this side. We'll talk about it in a moment. Okay, let's first write down these two things: car AC, window AC, and split AC. Okay, irrespective of any company, there is some data given to us regarding this. Car AC standard deviation is given to us. Correlation coefficient with the market is also given. Correlation coefficient 0.30, 0.35. Car and window, right? Car and window. And correlation coefficient 0.6 and 0.7. So there is no such data of split AC. You can clearly see. And now there is one company which has included all these three types of ACs, and the weights in which that has been included is given to us here: 60, 25, and 15. So ABC company includes this car AC to the extent of 60%, window AC 25, and split AC 15. Am I right? Let me just check. Car, window, split. Okay. So this is basically the data. This standard deviation or correlation coefficient has nothing to do with ABC. I'm not saying that this is ABC standard deviation. No. This is standalone standard deviation in the market. So whosoever will include car AC in their portfolio, they will get the standard deviation and the correlation coefficient. Okay, that's good. There is another company who also has included two of the three ACs. And what are those? See, a company who derives half its value from split and half from window. So let's write down half from split and half from window. Okay, good. And then that company which includes 50% of the split AC and 50% of the window AC has the standard deviation of 0.50 and coefficient of correlation with the market of 0.85. See, I will just write down. Standard deviation let me just make it very clear. Instead of saving the space, it's better to write it in a proper way. Another company and standard deviation and correlation coefficient. Okay, this is window. No, that's fine. Okay, now if we write it, the standard deviation, see, the standard deviation and coefficient correlation of the entire company is given to us now. The entire another company, which is 0.5 and 0.85. So this is 0.5 and 0.85. Just stay with this data. I will tell you how to solve it. Now, index has a return. Index means what? Underline this and write down market. Has a return of 10% and a standard deviation of 0.20. So here we are going to write RM and a standard deviation of M. 10 and 0.20. Are you okay with this? Then further, the risk-free rate of return is 4%. So RF is equal to 4%. Okay, cool. Now the first thing that we have to find out is the beta of ABC Limited. We have to find out the beta of ABC Limited. The entire company's beta. That means we will have to find out the beta of all the three ACs and the weights of all the three ACs in ABC. We already have the weights. The only thing that we have to find out is the beta of these ACs. So step by step. Beta of ABC is equal to summation of weight I beta I. This is going to be weight of car AC, beta of car AC plus weight of window AC, beta of window AC plus weight of split AC and beta of split AC. Am I right? Weighted average. We already have the weights 0.625, 0.60 into plus 0.25 into plus 0.15 into. We are required to do is calculate the beta of these three. Right? Now, how to calculate the beta? Let's write down. Beta of car AC. Beta is calculated using two different methods, regression analysis and correlation analysis. And you clearly know that the data regarding regression analysis is not given to us. Instead, they have already given to us about information about the correlation analysis. So we will use that method. Okay. Correlation analysis says that covariance of car AC with market divided by standard deviation of market square, or the variance of market. We can also write down this formula as correlation coefficient of car with market into standard deviation of car divided by standard deviation of market. Am I right? One standard deviation of market from this point will be removed with the denominator. You remember the formula of covariance of CM. Covariance formula is correlation coefficient into standard deviation of car into standard deviation of market divided by standard deviation of market square. Now this one standard deviation M from the numerator and one from the denominator can be eliminated. So we can reduce the formula before using it. RCM standard deviation of C standard deviation of M. So what is the correlation coefficient of car? 0.6. Standard deviation 0.3. So it will be 0.6 into 0.3 divided by 0.2. Standard deviation of M. That's 0.9. In the similar manner, you will calculate the same for window. It will be, see, 0.7. So 0.7 into 0.35 divided by 0.20. That's 1.225. Now the problem is with the split AC. We cannot calculate the beta in the same manner for the split AC because the data is not given to us. The data regarding the standard deviation and correlation coefficient is not there. So we have to find out another way to calculate the split AC, and then we come across the details of this. Split AC is also here. window AC is also here. And understand, we have already calculated the beta. We have already calculated the beta. Let me just write down. This is standard deviation, correlation coefficient, beta 0.5 and 0.85. 0.5, 0.85. See, out of the window AC and split AC, we have calculated the beta of window AC, which comes to 1.225. Now, focus on this point. With the help of standard deviation of another company and correlation coefficient of another company, this two data, in the same way we used this two and calculated the beta, can we calculate the beta of the portfolio for another company, not for ABC, for another company? With the help of window beta and the portfolio beta, can we calculate the split beta? Yes, sir. Weighted average method. Yes, we can do that. Window AC, weight multiplied by beta, it will be like this. Weight multiplied by beta, weight multiplied by beta, and the total of these two should be equal to portfolio beta. So if we have this figure and this figure, can we calculate this one? Yes, obviously. So let's start. Beta of split AC, and under that we are going to do all the calculation. Beta of another company is equal to correlation coefficient of that company with the market into standard deviation, that company means another company AC, with the market ACM. Standard deviation of another company, standard deviation of market. Have a look. Correlation coefficient is 0.85, standard deviation is 0.5, and market standard deviation is 0.20. So we will get to know the beta of the entire another company. That's 2.125. And this can also be stated as the summation of weighted average beta, which includes two types of ACs: weight of window AC, beta of window AC, plus weight of split AC, beta of split AC. Now, weight is 0.5, window beta of the window AC is 1.225, plus window split AC weight is 0.5, and the beta of split AC is to be calculated, should be equal to 2.125. Am I right? Now you may raise a question that how can we use this beta which we calculated with the data of ABC Limited in another company's data? First of all, you are understanding it totally wrong. Have a look. This beta of car and the beta of window does not pertain to ABC Limited. In this three data, only weights pertains to ABC Limited. Correlation coefficient and standard deviation is a standalone figure. This has no relation with ABC. This has no relation with ABC. So obviously, beta of the car has no relation with ABC. Beta of the window also has a no relation with ABC. Whosoever will include the car in their portfolio can take this figure. Whosoever include the window in their portfolio can take this figure. So obviously both the companies are taking car AC and window AC. That's why both the companies will be using the betas. Let's find out. 1.225 into 0.50 minus 2.125 plus minus divided by 0.50. So the beta of split AC is 3.025. You have three different betas now, right? You can put it here. 0.9 car AC, 1.225 window AC, and 3.025 split AC. 0.6 into 0.9 M plus 0.25 into 1.225, 0.15 into 3.025. So the answer is 1.3. This is your first answer.
beta of the entire portfolio 1.3. Do you understand how this question has been framed now? This is a little tricky question, but I think very entertaining, like very much where you have to apply your brains. From here and there you are calculating the answers. So this is your first answer, beta of ABC Limited. It is simply the weighted average of the betas. For that purpose we had to calculate the weights, we had to calculate the betas of individual security. Now we have to find out cost of equity of ABC Limited. It's very simple. Since you have already calculated the beta of ABC Limited, cost of equity RF plus beta in bracket RM minus RF. So RF is given 4%, beta calculated from here, and RM is also given. So we have all the figures, 10, 4 and this 1.3. 4 plus 1.3 in bracket 10 minus 4. %11.8%. Cool. Till this point, the company only had equity in its portfolio, in its capital structure. But now the company is thinking of raising the debt. And how much? Half of its market value. Half of its market value. Then determine equity beta. Then now we have to find out equity beta. If the yield of the debt is 5%, that means we can say KD is 5%. Cost is 5%. Let's find out. See, first of all, it comes to weight. If this is equity and if this is debt, okay. Earlier, the entire company was of equity only. So let's say, for example, 100 rupees is the total market value of equity, the company. And now we are raising half of its market value, that means 50. So after raising debt, the ratio will be 2/3 and 1/3. But in this question, they have assumed that this is the market value after raising debt, of which half is done. So equity and debt 1, 1 and 2. That means 50%, 50%. That means the market value that they were talking about was not 100. It was this 2, or you can say 200. 100, 100, 200. So they were talking about the after raising debt market values, half will be raised as a debt. So 200 into 50%, 100. So what they wanted to say is take equity as 50% and debt as 50%. Now this is what I derived from the answer by the institute. But if you go through a logic, this is more appropriate, the first one. And in exam, whatever you do, please make a note of it. Make sure you put a note of it that you have assumed the market value to be 100 or 200. Whatever you do, you should put a note of it. Okay. So now the weights are very clear. We have to find out the equity beta. See, beta of ABC is equal to 1.3. We have already found that out, 1.3. And now it will be calculated as weighted average summation of weight I, beta I. What are the two different types of categories in this beta? It's very simple. Weight of equity, beta of equity plus weight of debt, beta of debt. We already know 1.3. The weight of equity is 0.5 plus weight of debt is 0.5. Now we have to calculate this in the question, beta of equity, right? Beta of equity. For that purpose, we only need this thing, beta of the debt, beta of the debt. Once we come to know this figure now, it's very easy to calculate beta of the equity, and that's what the question is asking us. So beta of the debt is calculated using CAPM. Cost of debt CAPM. Cost of debt is equal to risk-free rate plus beta of the debt in bracket market return minus risk-free return. Am I right? If I'm calculating the cost of debt using CAPM, I will have to put beta of debt, and cost of debt is already given in the question as 5%. Yield return to the investor, risk-free rate is 4.
plus beta of the debt 10 minus 4. So 4 will be transferred to this side and it will look like this. 5 minus 4 is equal to beta of the debt 10 minus 4. So beta of the debt will be 5 minus 4 divided by 10 minus 4. That's 1 by 6.1667. I did it purposefully, this 5 minus 4 and 10 minus 4, because now just focus on this. What exactly is this? 5 minus 4 divided by 10 minus 4. This entire equation has been derived from the CAPM method, and have a look on the answer by the institute. They have directly taken it as 5 minus 4 and 10 minus 4, and the beta is this. Lots of students started asking me from this compiler that what kind of this formula is. This is what the mistake with the students are. Don't blame institute or anyone else. Did you try it before you looked at this answer? No. And that's why you are now confused. If you would have used the CAPM method, you would have already known that this is how it has been arrived, and the institute is not writing the formula and every step there. That's the mistake. But you should be very smart at this point. It is nothing but the CAPM only, capital asset pricing model. You put this figure 0.167 here and you will get the beta of the debt, beta of equity. 0.167 into 0.50 minus 1.3 plus minus divided by 0.50. The answer is beta of equity. Let me just calculate once again. 2.433. Let's just find out if it's right or not. Yeah, 2.433. Getting it? So this is your entire answer from the start to the end. See, it was not that big. It started here and ended here. Understood each and every step. This was pretty good question. I liked it. You will keep this as homework. Why I am giving you this as homework, I will tell you. This is asking you to find out the expected return of the portfolio. So how are you going to calculate the portfolio return using CAPM? It's very simple, sir. RP is equal to risk-free rate plus beta of the portfolio in bracket RM minus RF. Now understand, government securities RF is given to you, RM is given to you. The only figure that you need to find out is beta of the portfolio. Now, beta of the portfolio is nothing but summation of weight I, beta I. Okay, beta is already given to you, and you will have to find out weights. You can easily find out weight with this figure. The amount of investment is given to you. You can take the total of it and then find out the weights of each of the security. Multiply it with the beta, total it, you will get the portfolio beta, put it in this formula, you will get the expected return. So was it this much difficult? Is it difficult? Is it difficult? No, sir. Everything is very well planned. Now, this is something new that you will learn. Advise whether we should replace the security better with Nifty. I will tell you here. This is better. Security better. Now the question is asking you, should you replace the better security and eliminate the better from your portfolio and put Nifty, that means the market, in that portfolio? My answer is, it will not change the portfolio return that we have calculated. Why? I will tell you. Because the beta of better security is 1 and the beta of Nifty is nothing but the beta of market, which is also 1. So even if you replace it with Nifty, the beta still will be 1. The investment will be same. The weights will be same. The portfolio beta will be same. And the portfolio return will come to the same thing. So why do we have to make this change? We should make a kind of a change where we are getting a better situation, more profit, higher return. But if this is not changing anything, why to make a change? So the answer is, it makes no difference in replacing security better with Nifty, as the beta of better and Nifty is same, that is 1, which will not change the portfolio beta, ultimately not changing the portfolio return. That is how you should answer. Everything is written over here. You can just read it and
complete the question. Okay, sir, this is something new. We are going to learn a new concept in question number 57. Let me take the break and I will be back with question number 57. Stay connected. Okay, so before starting this question, I just want to explain one small concept to you. There are three types of market lines. What is market line? We will talk about it later, but just focus on one thing. This is called as capital market line. This is security market line. And the third one is called as securities characteristics line. Okay. Now, securities market line is based on the concept of capital asset pricing model. What does that mean? It means the formula of this securities market line is nothing but Ri is equal to Rf plus beta I in bracket Rm minus Rf. So this is the same formula as capital asset pricing model. Yes, exactly, this is the same formula. But did you know one thing? The real formula was like this: beta of I divided by beta of M. Because we wanted to say that without taking any risk, this much should be the return that you should receive. And if you are taking the risk of this much, the beta of the market, if you are taking the risk of the 1 unit, that is the beta of the market, you should get the market risk premium. The premium from the premium, that is the difference between the market return and the risk-free rate of return. So in one of our example, the figures were like this: 11% was the Rm minus Rf, the beta was 1. That means if you are taking a risk of 1 unit, the premium that you should receive over and above the risk-free security, risk-free rate of return, is 11%. This risk-free rate of return was 4% at that time. Do you remember that? So 11% of the premium for 1 unit of return, then how much is the premium for this much unit of the return? That is how actually the formula is. But we know that beta of the market is 1. And dividing by 1 does not make any sense. That's why we never used beta of market in the denominator, because it will not change the formula, it will not change the answer. So we eliminated writing this every time we used capital asset pricing model. But there is some theory which says that the premium of 11% should be given on the total risk and not just on the systematic risk. See, you can clearly see that the premium of 11% is not given in this equation on the unsystematic risk. They say that the premium should be given on the systematic risk only in the securities market line. But there is another theory called as capital market line. This says that the premium should be given on the total risk, and just because of that, the formula will look like this: Ri is equal to Rf plus standard deviation of security divided by standard deviation of market in bracket Rm minus Rf. How do you interpret this? This says that the premium of 11% is given if the market risk is this much, then how much should be the premium for the security risk of this much? And total risk. This includes systematic and unsystematic. This includes only systematic. And the difference between the two theories is just that they say the premium should be given on total risk. They say that the premium should be given on the systematic risk only. So this is what you will use. Now this is going to be used in this question, capital market line. And I will talk about the securities characteristics line later on. But in a summary, it is based on the Sharpe's index model. So this is the formula that we are going to use. Have you understood the formula? There is no difference in the CAPM and this formula except for the fact that it considers total risk, not just systematic risk. Have a look. If the rate of return and standard deviation of market, that means Rm and standard deviation of M,
RM is 8%, standard deviation of M is 6%, risk-free rate of return is 5%. You are required to construct an efficient portfolio which produces an expected return of 7.5%. A portfolio which will include market and risk-free securities, because nothing else is given in this question. So how are you going to construct a portfolio? What are the things or the securities or the investment you will put in the portfolio? Market and risk-free. Okay, the portfolio return is given to you. You have to calculate what should be the weight of risk-free security and weight of market in the portfolio. Okay, isn't it easy? Yeah, it's easy. Question number 57. First answer. Portfolio return is nothing but summation of weight I RI, which is nothing but weight of risk-free security multiplied by return of risk-free security plus weight of market multiplied by return of market. No, we don't know yet. 7.5 is the return that we need. Let's say the weight of risk-free security is WRF into return is 5%. Can I say the weight of market can be written as 1 minus weight of risk-free security, because there are only two securities in the portfolio. If weight of one security is this much, the weight of another security will be 1 minus this much into 8%. Let's solve this equation. 7.5 5 weight of risk-free security plus 8 minus 8 weight of risk-free security. Minus 0.5 is equal to minus 3 weight of risk-free security, and weight of risk-free security is equal to 16.67%. That means automatically weight of market will be 83.33%. So whatever amount of investment that you want to put it in this manner in a portfolio, and the portfolio will give you a return of 7.5%. Put 16.67% of your total investment in risk-free securities and the balance in the market, and this portfolio will give you the return of 7.5%. Are you okay with this? The first answer, very simple. The second answer, calculate the risk of the above portfolio. Very simple, sir. According to, now we will start writing this capital asset pricing model. Capital market line, not pricing model, capital market line. So you will face some difficulties in remembering the name. Capital asset pricing model is the securities market line, and capital market line is different. So capital market line, return of the portfolio is equal to risk-free rate plus standard deviation of the portfolio divided by standard deviation of the market into market return minus risk-free rate of return. So this is the capital market line for this portfolio. How much is the return of portfolio? 7.5. Risk-free rate of return 5%. Standard deviation of the portfolio is asked to be calculated. Market standard deviation 6% given in the question. RM 8. RF 5. You have everything with you. So 2.5 divided by 2.5 into 6 minus 3. Standard deviation of the portfolio comes to 12%. The answer to this question. Let's look at the answers. 83.33 in the market and 16.67 in the risk-free. Standard deviation of the portfolio 5%. Let me just check once again. I think I'm making some mistake. 7.5 minus 5 multiplied by 6 divided by 3. Right. Instead of dividing it by 3, I think added 3. So added or something like that. It should be 5%. That's just a calculation mistake. Everything else is correct. Are you okay with this? Unless and until you understand the logic of capital market line and why standard deviation is used there, because of the theory. Okay, then the last part of this question asks about the same thing again. Instead of
Yeah. Suppose Mr. X has 1 lakh rupees of his personal funds, then how he would construct his portfolio giving an expected return of 10%. So the two part now are again asked in the third one. Again we want to explain what should be the weight of the risk free security and market, so that the portfolio return is not 7.5, now it should be 10%, and at that 10% what should be the standard deviation of the portfolio. Have a look. Again we are going to repeat the same thing. Third one, portfolio return is nothing but weight of risk free into return of risk free plus weight of market into return of market. Weight of risk free into 5% risk free rate of return, 1 minus weight of risk free into 8%, and we need 10% in such a manner. So the next will be 5 weight of risk free return plus 8 minus 8 weight of risk free return. So if you'll transfer 8 on this side, it will look like this. 2 is equal to minus 3 weight of risk-free return. So weight of the risk-free return is nothing but minus 66.67%. Now the weight for the first time in our calculation, like after 56 questions, the weight of a particular asset in a portfolio is coming to negative. And you should understand what does that means. Also the weight of market will be 1 minus weight of risk free security, that is 1 minus 0.6667. Okay, just a second. Weight of risk free security 1 minus, and the weight of risk free security itself is negative, so it will be 1.6667, that is 166.67%. This is the weight. Now let me just explain this to you. Whenever you create a portfolio A and B and you put 10 rupees here and 20 let's say 30 rupees here, the total amount of the portfolio comes to 40 rupees. And if we calculate the weights, 25% is seen that we have invested in A, and 75% we can conclude that invested in B. Did you just observe what I said? I said 25% invested in A, 75% invested in B. In both the cases, I used the word invested. Why? Because the weights were positive. If I say like this, if A has, let's say, we'll take this multiplied by 1 lakh, that is 66,670, multiplied by 1 lakh, that is 166,670. Now if our portfolio looks like this, what do you call it? Risk free security and market, we have negative 66,670 and 166,670. That means negative 66.67% and positive 166.67%. In both the cases, the weight will come to 100% only, and the net investment will only be the amount that you have invested from your pocket. Now what will you call this? If you call positive figure as invested in A and B, can we say that the negative figure is borrowed from risk free security, borrowed from A and B? If A and B would have been negative, we would have called that we have borrowed this much of the amount, not invested. Plus sign, the opposite sign is there in risk free security, so the opposite treatment will also be there. Instead of investment, we will call the exact opposite of that, which is borrowings. So what is the portfolio? Portfolio consists of a borrowing and an investment. Now you are going to learn this from this question and keep it in mind forever in your life, that creating a portfolio does not always means investing. It can be a combination of borrowings and investments. And now this is the question where we are seeing such type of an example, where we are borrowing 66,670 rupees at risk free rate, okay, where we are not going to earn anything, it will be a cash outflow. that amount is included with the amount that we already had in our pocket, that is 1 lakh, and entire amount 1,66,670 is being invested in the market. So this is your portfolio. Your portfolio's net value will always be the one which you have put from your pocket, 1 lakh, and the total will always be 100%, but it will look like this. Have you understood this? Okay, so the weights can be negative from now onwards. You will keep that in mind. Then standard deviation, again we will calculate it with the capital market line. Portfolio return is equal to risk-free return plus standard deviation of the portfolio, standard deviation of the market, RM minus RF. We wanted 10% of the return, right? Risk-free rate 5%, standard deviation of the portfolio, market standard deviation is 6, and 8 minus 5. Let's find out standard deviation of the portfolio here. 10 minus 5, 5 into 6 divided by 3. So this goes to 10%. You will see in the first part, the return of the portfolio was 7.5% and now it is 10%. Okay. But the standard deviation of the portfolio was 5% and now it is 10%. So just for the purpose of increasing the return of 2.5%, we have increased our risk by double, like 5%. We have doubled our risk just for the increase of 2.5% in the portfolio return. This is the entire question. I hope you have liked it. I enjoy such type of question where we get to learn something new. Where the things are repeated now, then it becomes monotonous and we feel like it's all about the calculation, just put the figures and find out the answer and nothing else is there. I obviously want you to achieve that position so that I can conclude that you know everything now. Question number 58. Question number 58 is nothing new. First of all, you have done such type of question. The only thing which is different in this question is the manner in which they have asked a particular thing. I will just explain that to you. Suppose one of your high net worth individual client, HNI client, is holding the following portfolio as per his risk appetite. He has purchased the shares of 1000 shares of G Limited, 1000 of S Limited, 500 of B Limited, and public sector undertaking bond 20,000. Okay. Then the other data, the cost at which he has purchased the shares. Okay. Please underline one thing. Each of these shares. So the data given in this particular table is for every single share or bond. Okay. So he has purchased the shares of G Limited at 10,000 rupees. Can I multiply this with 10,000 rupees? We will get 1 crore. Then 1000 multiplied by 15,000. This will be 1.5. That is 1 crore 50 lakhs. 500 multiplied by 28,000. 1 crore 40 lakhs. 20,000 multiplied by 1800. 3 crore 60 lakhs. That's 7 crore 50 lakhs. Can you see one thing in this portfolio? Our client is more inclined towards safe investment, risk-free investment. Public sector undertaking bonds, that is the maximum investment that he has made. 3 crore 60 lakhs out of 7 crore 50 lakhs. It's almost 50% of the investment in that. So if we find out the weights, we can easily get to know. This is market value and let's say these are weights. So 1 divided by 75 into 10. That's 0.1333, 15, 0.20, 14, 0.1867, 36.48. 48% of the total investment is made in the bonds. That means he is more inclined towards risk-free security. He doesn't want to take much of the risk. Now, this is dividend. Can you see? The dividends are given to us. Market price is also given to us. The market price minus cost will give you the capital appreciation. That capital appreciation should be added with the dividend. See,
Here the capital appreciation is minus 200. 9,800 minus 10,000. So this is going to be 1525. Here the capital appreciation is 1,200. So the total will be 2,200. 28,300 minus 28. So 300 plus. So this is 1,700. And 1725, 1,800, that is 75. So that is going to be 255. Now what you have to do is simply multiply the total return. This is nothing but the total return with the number of shares, and you will get to know the total return in each share, and do the total of that to reach at the total of the return. See, I will tell you. 1725 of dividend minus 200 capital gain 1525. In this manner you have calculated everything. Okay. This was, we were wrong at this. This is minus. So this comes to 105. When we multiplied this with the numbers, we arrived at the total income in each of the shares, and this is the total income of the portfolio. Now this total income of the portfolio, when divided by the total investment, we got to know about the portfolio return, which is 8.90%. This is nothing but the rate of return on the portfolio. This is RP. Okay. Now your client is interested in investing some more funds in bonds issued by the government of India. Again, he wants to invest in the government of India bond. That means he wants to again go for the safe investment, risk-free investment. Estimate the minimum rate of return that your client would expect from these bonds, keeping in view his risk appetite. What kind of risk appetite that this client is carrying? No risk. He doesn't want to take a risk. That's his risk appetite looking at the investment. So he wants to play safe, and the question is asking you how much minimum that he will expect from the bond. What exactly they are asking you? If he is playing safe, the minimum that he will be expecting, is nothing but the risk-free rate of return. Because in CAPM, see what happens in CAPM. Ri is equal to Rf plus beta in bracket Rm minus Rf. CAPM, it's very clear that the risk-free rate of return is added first, because this is a return which anyone can earn without taking any risk. So tell me one thing. If you have to invest anywhere else other than this, the minimum that you will expect is this much, because no less than this return is expected by you in any kind of a security. No less than this. So the minimum return is nothing but the risk-free rate of return. This entire calculation is asking you to just calculate the risk-free rate of return, and we have seen such type of questions. But the requirement was clearly given there that you have to find out risk-free rate of return. Instead of the direct wordings, they have given you some other thing, and from where it is very difficult to find out what is exactly they are asking. So this is where you need to be smart. Mugging up the formulas won't give you an opportunity to clear the exam. Understanding what is RF and why it is there. RF is added without anything in the CAPM. So no matter what, this much is the minimum return for every CAPM return. This much will be the minimum answer. So this is nothing but the minimum rate of return. Okay, so we have to find out RF. Now please understand. We have already calculated the return of the portfolio. We can calculate the market. The market return is already given 12.70. The only thing which is required is to calculate the portfolio beta. The moment you will calculate the portfolio beta, you will have everything required in this formula to calculate risk-free rate of return. Now the betas are given to us. The weights are also given to us. Just multiply weight with the beta. Calculate the weighted average portfolio beta. Put it in this equation and you will find out risk-free rate of return. The first answer is ready with you. Okay. Analyze whether this portfolio has outperformed the market. Now we have to find out with the given risk-free rate of return. See, 8.90% is the actual return. Now you calculate the CAPM return.
This is going to be the required return, and compare that return with the actual. Then we will be able to explain whether we have outperformed the market, assuming a risk-free rate of return of 7%. So understand, what is the portfolio beta? Let me just find out the portfolio beta. This is the portfolio beta. You can calculate it in your own manner, weight into beta, still the answer will be same. So do not question whatever has been done here. If you are questioning everything which has been done here, that means you have not solved the question first by yourself. You are directly looking at the answer, and that's where you are going wrong, my friend. Sorry for scolding you. You might have faced, you might be scared of me by now. Okay, so 0.4. Now, if we put it in CAPM, 7% is the risk-free rate of return, 0.4 is the beta, market rate of return is 12.70 minus 7. So the required rate of return comes to 9.28%. So this much is the required on this portfolio, and how much we are earning? Only 8.90. Look at the actual return. Do you think we have earned more than required? No, we have earned less than required. That means the securities are purchased at a higher price. That's why the earnings are less. Higher price means overvalued, means we have not outperformed the market. We are not earning any extra return. Outperform the market, that means we have earned more than expected, more than required. No, we are not earning more than required. Not outperformed. Okay with this question? Let's move on to the next one. Question number 59. See, question number 59 in front of you. We are going to learn something new in this question as well. So from this question onwards, I think there will be some value addition in almost every other question. The repetitive ones are going to be solved by you, but most of the question from now onwards, because only 35 questions are left in this chapter, and you might have seen that in very fast we have shifted to from first question to 60th question. Have a look on this one. A portfolio manager has the following 4 stocks in his portfolio: 1, 2, 3, 4. VSL, CSL, SML, APL. Okay. Number of shares, market price, beta. The one thing that you can do here directly is put 2 different columns. I mean, in the answer, not in the question. Put 2 more columns in between. The first one is number of share multiplied by market price, which will give you market value. Based on the market values, you can calculate the weights. And please make sure that you are calculating the weights in a shortcut manner with the less number of keystrokes on the calculator. You know the trick, right? Now, then multiply this weight with the beta and put a last column here to calculate a weighted average beta. This will be your portfolio beta, and this is going to be the first answer. I'm not taking this anymore now. Okay, we have already solved lots of questions with portfolio beta. If the PM seeks to reduce the beta, PM means not Prime Minister. Prime Minister will not do such kind of work right now. Okay, it's you and me who has to do that. Portfolio manager. It's portfolio manager who seeks to reduce the beta. Now, what is exactly the current beta? The current beta is 1.108. So we need that. 1.108. If the portfolio manager seeks to reduce the beta to 0.8, how much risk-free investment should he bring in? What he wants to do is to reduce the beta of his portfolio from 1.108 to 0.8. Agree. That means he wants to reduce the risk of the portfolio. The portfolio risk can be reduced only by investing more in the risk-free securities or lesser risky securities. So either can be out of the 4, or you can include additional securities like risk-free investment. So the question is, he wants to bring in the 5th security in his investment portfolio, and please understand, it will also have some market value, whatever it is, and it will have a beta of 0. So automatically what will happen? If some of the weight will be assigned to risk-free security, the weights of rest of the securities will be reduced, will get reduced automatically, and the reduced weight will again be multiplied to the beta, and the total will be 0.8. So we have to find out such a such an amount of investment for the risk-free security which will make the beta to 0.8.
Now, pay careful attention because the next question is your homework. One, two, three, four. These are four different securities. The total of this portfolio is 12 lakh rupees. Okay. And the beta of this portfolio is 1.108. Now we want to bring some extra securities in the portfolio. So can I say this is going to be the new portfolio? So this will be called as new portfolio. Can I call the previous portfolio as old portfolio? So can I say that the new portfolio has two assets, risk-free security and the old portfolio? Am I right? Risk-free security and the old portfolio. Okay. Amount, weight, beta and weighted average beta. Now understand the logic. There will be some amount here as X. So the total investment will be 12 lakhs plus X. Okay. And the weight, please understand, the weight will be something. There will be some weight of the old portfolio. This 12 lakh divided by 12 lakh plus X will be some weight, right? So we will call this one the weight of the old portfolio in the new portfolio. Can I say this figure, the figure that we are going to arrive here, is the weight of the old portfolio in the new portfolio, and risk-free security will also carry some weight in the new portfolio. Let's start with that. Instead of putting X here, let's start with the X as the weight of risk-free security in the new portfolio. So can I say the old portfolio's weight is 1 minus X? Or we can do it like this also. Let's say the X is the weight of the old portfolio in the new portfolio. So 1 minus X is the weight of risk-free security in the new portfolio. The total weight has to be 1. Okay, what is the beta of risk-free security? Since the name itself says that it is risk-free, the risk will be 0. When you multiply the weights with the beta, you should get some figures. This is 1.108x plus 0 and it should come to 0.8, and that's our target. We want to reduce the beta of the portfolio to 0.8. Do you agree with this much of the part? Now you can easily solve 1.108x is equal to 0.80, right? You will find out the X, which will become the weight of 12 lakh rupees in the new portfolio. Now just understand, before the calculation, if this weight comes to be 50%, that means 12 lakh rupees is just 50% of the total. So 12 lakh rupees divided by 50% will give you the total value 24 lakh rupees, and 24 minus 12 will give you the amount of risk-free security. This is how the entire thing will go on. Now let me start with the proper equation. Beta of the new portfolio is nothing but the summation of weighted average. So weight of the old portfolio, beta of the old portfolio plus weight of the risk-free security, beta of the risk-free security. Am I right? Okay. So we need beta of the new portfolio to be 0.80. What is the weight of the old portfolio? Let's say it is X. The beta of old portfolio 1.108 plus weight of the risk-free security 1 minus X into 0. So this entire part will become 0, and it will look like this. 0.8 is equal to 1.108X, and X is equal to 72.20%. This X, what is this X is for? X is the weight of old portfolio in new portfolio. Therefore, amount of new portfolio, or value of new portfolio is equal to value of old portfolio divided by weight of old portfolio in the new one. You will get a 16,62,050 less old portfolio's value 12 lakhs and the balance is 462,050 risk-free security. What does that mean? If you bring the risk-free security of 462,050 in the portfolio, the total portfolio will become 12 lakhs plus 462,050 and the total will be 16,62,050 and the new beta of the portfolio will automatically come to 0.80. You can do the calculation and that has been done in the answer itself. Have a look. 0.8 divided 462,6050. Now you should understand what has been given in the institute's material. They write the answer from the middle of something. They have straight away written it should come 0.8 divided by 1.108. Now you will spend the entire day understanding the logic of 0.8 divided by 1.108. It is nothing but this. When you transfer this 1.108 to this side, it will come to 0.8 divided by 1.108. And this has come from this formula itself, weighted average. So you don't have to force yourself to understand. What I can say is, I'm not getting a proper word to it, but you don't have to doubt your ability to solve the question or doubt the answer that there is something new. This is something new concept. No sir, this is not a something new concept. Right? Getting it? This is the same. This entire figure comes from this step. The only problem with the institute is that they have not written each and every step. Okay? Otherwise you will easily get the answer. So this is it. Now, revised portfolio will look like this. You will have the total investment of 12 lakh as it was before plus 462,050. Now the total value will be 16,62,050. You will revise the entire weights which will be again multiplied with the beta and the total will come to 0.80 automatically. Getting it? Now, the second part. If the portfolio manager seeks to increase the beta, he wants to increase the risk to 1.2, from 1.108 to 1.2, how much risk-free investment should he bring in? Please understand, the last time you brought some risk-free investment, the portfolio beta got reduced. Now, even if you bring 1 rupee of the risk-free security in the portfolio now, the portfolio beta will get reduced because the security that you are bringing in has no risk. So if you want to increase the beta, it won't be of any use putting money into risk-free investment. Instead, if we have to increase the beta with the risk-free investment, we should not invest in it. We should borrow it. What will happen? That will give the negative. Please understand. That will give the negative sign to the weight of risk-free investment, which will automatically increase the weights of rest of the 4 securities. Increased weights with the beta multiplied with the beta will give you increased portfolio beta. Understand the logic step by step. If you will put a negative sign here, or I will say, just have a look on this. If you will put a negative sign here, the weight of this entire, the weight of all these shares will get increased. From the previous one, it will be higher weight. Higher weights multiplied with the beta will give you higher portfolio beta. Now, in the similar manner, we have to do it. Let's have a look on the answer. Portfolio beta is nothing but weight of the old portfolio into beta of the old portfolio plus weight of risk-free security into beta of risk-free security. You know that this entire answer will be 0. Portfolio beta, the new beta that we need is 1.20. Weight of old portfolio is X, and the beta of old portfolio is 1.108. So when you calculate 1.20 divided by 1.108 comes to 1.0830. This is the weight of 12 lakhs in the new portfolio. So new portfolio value will be 12 lakhs divided by 1.0830. 11,08,033. That means the total of the portfolio net should be 11,08,000. So understand what I'm saying. This is already 12 lakh rupees and this has to be 11.08. How are you going to invest in risk-free security to make the total of the new portfolio as 11.08? Only when this will have a negative sign. That means you will have to borrow the difference between these two, 12 and 11.08. Have a look. This is 11.08. When you deduct it from 12 lakhs, you will get an answer of 91,967. So 91,967. Divest. What does divest means? Borrow 91,970 of the risk-free asset. The moment you will do it, your portfolio will look like this. Understand? There is some printing mistake here. It should have been 11,080, I think, minus 91,970, 11,08030. 08030. So please make correction in your compiler. I will do the same in the next edition. 11,08030. It was just it happened just because of the what we can say is copy paste from the staff, because of that thing. Okay, so this 5 lakh to 4 lakh will be 12 lakhs and this is minus 0.91970. This will automatically increase the weights of these, and since the beta of the risk-free asset is 0, this entire figure will be 0 and rest of the figure will be increased figure than the current one, and the final answer will come to 1.20. This is another approach, but I will not suggest you to go for it because it will take a lot of time to solve this question according to it. But if you have time and if you have attempt like after 1 or 2 years, then I will surely suggest you to just have a look on how this approach has been followed. But if you have the attempt in coming 1 or 2 months or 3 months, don't go with this because you do not have the time. See, this question is your homework. This is similar. 4 securities, everything is given to you in the question, and you have to calculate the present portfolio beta. You can do that, and only one part is given, which is reduce the beta to 0.8. So you can do it. You can take it as your homework. So question number 60 is over. Now from question number 61 onwards, I will start in the next lecture. I think this much is enough. From question number 36 to 60, we have completed a lot of questions till now. And the journey is going to be very interesting and learning and little difficult, because till now you might have felt that the questions are very easy in portfolio management, but it is not the case. You are going to face lots of concepts now from 61 question onwards. See you in the next lecture with a new concept. Bye bye.